A so-called reverse currency war is taking place between government and central bank of each countries, and central banks to raise the value of their currencies and lower the exchange rate as the world suffers from inflation due to a surge in import prices. Till now, most countries have tried to keep the exchange rate as high as possible, believing that a low currency would help increase exports and trade surpluses. In the process, conflicts between countries often escalated. However, as the sudden arrival of inflation and the high exchange rate equal increase in exports formula weakened, countries are making efforts to prevent currency weakness. After the 2008 financial crisis, major countries focused on lowering their currency values to expand exports and promote growth. In general, when the value of the domestic currency falls, the price competitiveness and profitability of exporting companies increase, which acts as a positive factor for exports. At the same time, many countries have waged the exchange war by deliberately depreciating their currencies to improve their trade balance. However, as prices rose sharply after the corona pandemic, the old unwritten rules of the foreign exchange market was broken. In the inflationary phase, a fall in the value of the domestic currency actually raises import prices, which in turn fuels consumer price rises, causing more harm than good. The U.S. Central Bank is continuing its austerity measures. This is one side strengthening of the U.S. dollar. Central banks around the world are likely to speed up rate hikes to counter inflation and defend the value of their currencies. The so-called reverse currency wars are expected to intensify. In fact, the value of the dollar has risen sharply this year when the Federal Reserve heralded in aggressive rate hikes. The dollar index once broke through 104 after the Fed hinted the possibility of the big step in June and July earlier this month. This was the highest in 20 years. The dollar index is an indicator that shows the value of the dollar against the currencies of 6 major countries. On the other hand, currencies of most countries except for the dollar have been weak this year. Even the Japanese yen and Swiss franc, considered safe assets, have fallen more than 13% and 9% respectively against the dollar this year. In the case of Korea, it is fully responding to the so-called three-high crisis of high inflation, high exchange rate, and high interest rates. The Bank of Korea also says that it cannot completely rule out the big step of raising the base rate by 0.5 percentage points in a future.